Hey all, it's Kelly Hendricks with Delmar Mortgage. I have the pleasure of being in studio today with my friend and our partner, Jen McGuinness with Pivot Financial. We're excited to get together today to talk about all things mortgage, a little leadership, how we met and got on this journey together. So we're excited to have you here, Jen, and we appreciate you coming down. And
Absolutely. Absolutely. And, Kelly Hendricks here from, Delmar is one of the best in the industry. So I'm super excited about this one.
so we've hung out a little bit, known
Absolutely.
each other for at least conference calls, conferences for a while now. So tell us how you got into this business.
It was an accident. It's funny. I originally was a classically trained opera singer. And then when I decided to go back to regular school, I was going to be a lawyer. And, I graduated early and decided to become a paralegal. Ended up managing a national footprint for real estate based litigation law firm. And, figured it'd be a great way to figure out, legal research. Got poached by a client, and the rest is history. What's funny about that is when I was in music school, I actually also worked for a mortgage company and started my career as a mortgage underwriter and processor. So, it all was a happy accident, but it was a good one. So here we are today, 28 years later.
Yeah, it seems to be the common theme for most of us in the business is we fell into it and it
Hmm.
sucked us in, and we all like the dark side. So, we're all still here. So tell me a little bit about your early days on Wall Street and how that has really impacted your trajectory of your career.
Yeah, so I always like to say I grew up on a Wall Street trading desk, right? And I think, I had a thick skin, just growing up as a kid and whatnot. But I really think when, back then you have to understand that the first trading desk that I was on still had bourbon and cigars. And today that's like a big no-no, right? So, and the only other women that were there at the time, Kel, were the administrative assistants. And there
Hmm.
weren't that many people that were, women in the business. And there were a couple of us over the years. But I think that was an interesting thing for me starting out being really young
Hmm.
and, learning that. Wall Street teaches you multidimensionality, right? So I got to work on a lot of different things in all of my Wall Street roles. And, after being, first in lenders, then servicers, investment banks, law firms, after the investment banks, I also went on to hedge funds and REITs and, really being able to see how the different parties throughout, the entire life cycle of mortgage behaved and what their needs were and how to, get over all of the different challenges, I really think gave me a lot of the breadth of that, like kind of full life cycle expertise that I've been so lucky
Yeah.
to, obtain over the years. So I think that's been a big thing for me.
You're a problem solver.
Absolutely.
You like to
And
solve the puzzle.
uh-huh. And what's the coolest is I can literally take like somebody from a lender, a servicer, a this and a that, put them all around a table and say, okay, this is going to work for you, but it's not going to work for them. But if we do this and this, it works for both of you. And and that's something super cool. And it's something that I really love about what I do. And I'm one of those people that love to keep learning.
Hmm.
So like if I were getting bored, I probably wouldn't be here
The
still.
mirrors of our lives are just
1000%.
unbelievable.
Absolutely. And
Yeah.
but that's why you have your breadth of knowledge that you do and all the different products and multidimensionality. We both came from more of a school of hard knocks into this
Yes.
business. And I think that really sets you apart and it gives you enhanced opportunity.
Yeah.
That's actually one of the reasons I love working with Delmar. I tell your leadership all the time, Kelly, I love Delmar, but I love Kelly.
Well, I appreciate that. It's been a fantastic relationship that we've had. And, I think the biggest strength of our business is that we have these different trade organizations and avenues where a Jen and Kelly can come together, not only on a business level, but on a personal level, but
Yep.
we're able to solve the problems that alone we couldn't do on our own, whether that's finding a repurchase or exploring a new business opportunity. And, here at Delmar, we're so thankful that you are in our corner because we're able to expand what we're doing in a way that's scalable, profitable. And to be honest, it's fun when you're working with someone who is of a like mind and able to understand even without saying all the words what our goal is here. So, that happens though because of some of the organizations we're in.
1,000%.
And, I've had the wonderful opportunity to work with you with the Mortgage Leadership Council.
Actually, you're the reason I came to the Mortgage Leadership Council, if you remember.
The Mortgage Women Leadership
It's the
Council. I got to
Mortgage
make
Women's-
sure
yes,
I
it's so
get that name
the
right.
Mortgage Women Leadership Council, I had like heard about it, but actually the whole reason that I first started having the conversations about doing what is now the Breaking Barriers and some of the other things that we've done is because you were part of it. Obviously we got to have a shout out to our other girls, Megan and, all the girls there. But, that was really the draw for me. I was like, all right, so Kelly's doing this, I got to check out what they're doing. And, you actually introduced me to them and we started really working on, they asked, what do you want to do? And I said, I really want to be able to put together some frank, interactive conversations for women in the industry to be able to talk about things. And, men and women now take part
Absolutely.
too. And, but really the beginning stage of that conversation was you and me.
I really feel like a big part of my building blocks in this industry is having strong leadership and having women in leadership, because much like you, early in my career, I was usually the only female in the room, whether that was at an independent mortgage banker, but more so in the banking space.
Absolutely.
And being in the banking world, while we're still manufacturing the same product and ultimately selling it to the same outlets, it's very different to be an IMB versus a banker. And, having those times where you're in the room, your knowledge is there, but you're questioning yourself because your male counterparts are questioning you.
Yeah.
This Breaking Barriers series that we've done is really, I feel like, our way to help those future leaders, those future women leaders, learn how to be at the table, take charge of it, and embrace it in a way that we can continue to be successful in this industry.
Yeah, and I think, one of the great things about it, and it's all recorded, so, you can actually go, ladies and gentlemen, and sign up for the Mortgage Women Leadership Council on their website, and Breaking Barriers, and every session we've done is recorded and available. But what I like about it is we didn't do it in a guarded way, right? There's definitely conversations in there, Megan, Melissa, you, me, and people are asking questions, and we're telling them exactly what we think, not in a how do we need to reflect this kind of way, but in a reality kind of way. And I think, that's an important component too. You're never going to be able to deal with a situation if somebody always butters it up for you, right? If you can look at somebody and go, yeah, that's going to suck. And you know what? You're going to just have to deal with it, but you're going to deal with it in a better way if you go like this.
Yeah,
and,
absolutely.
I think that's where the real value out of those discussions come. I remember being at the conference and presenting there, and we put a visual in the deck for the ladies, and it was like, is there a glass ceiling? And it was a woman, and it had a Thor hammer.
Yes.
And the glass was already broken, and I was like, we really need to make T-shirts, with that visual on them.
But, through the Mortgage Women Leadership Council, we have obviously, we've worked together. We have our personal
relationship. We finally got to see each other in real life
exactly.
more often.
But it gives you this level of optimism that is, this business has its ups and downs, that there are strong leaders coming up through the ranks, and it's fun to watch them grow. And I think that's an important part of what we're doing. But that leadership piece is really important. And I think for you to tell us something about one of those pivotal moments in your career where you were trucking along, you're in a good spot, and something clicked for you that said, I think I want to go out on my own and do this. And, then you created Pivot Financial. So what were the roads that led you to creating your own business as a woman leader in the mortgage industry?
Yeah, I mean, I was really frustrated in some of my prior roles, and it wasn't necessarily because I couldn't do a great job in them or whatever. It was really more because so many businesses don't create businesses, they create trades. And, especially on the Wall Street side of things, when you're in certain hedge funds, REITs, investment banks, and all the other different types of entities, and lenders do it too. a fund will raise, $400 million, and then all of a sudden they need like 3 vendors in order to do 4 things, and they only want to hire 4 people,
Mhm.
and things like that. And they don't understand, when they raise that money on such a narrow investment strategy, if the market changes on you, you cannot pivot, no pun intended, right? You would literally have to go back to those investors, renegotiate your investment strategy, or quite frankly, wind it down and wind it back up.
Mhm.
Also, some of the frustrations where, you need to get 26 sign-offs or more in order to do almost anything. And it's not because of compliance, it's just because of process. And you could be doing so much more quickly. And at times you would literally miss the opportunity
Yeah.
because of how long that process had to be. So, I wanted to be able to, one, get private capital back into the market, and two, create a full life cycle platform to really be able to handle everything from, the aggregation of loans all the way through liquidation, because we're not a direct lender, right?
Mhm.
And I also wanted to be able to empower others with skill sets that candidly they don't have access to,
Yeah.
and or wouldn't want to keep on the full-time payroll, just candidly due to cost, right?
Right.
So Pivot does have the aggregation business, but our asset management business really does partner with lenders in order to enhance outcomes. And we've worked on a
And
few things
we've
with
seen it
Delmar,
firsthand.
and
Yeah.
you've seen what we can do. And I think that those partnerships are really important in empowering lenders, aggregators, and the like, and other counterparties in the industry with full life cycle skill sets and enhanced knowledge. Talking to you is not like talking to everybody in the industry, right? You and I can go, well, this is what it is, right? But let's talk about how we can still, get a great
Yeah.
outcome.
Absolutely.
And but that's a great partnership, right? Because you've got 2 really smart women and also teams
Mhm.
coming together and saying, hey, what's our best solution? Let's use our best assets, our best knowledge base collectively, and to get those best outcomes, right? And I think that that's really important.
When you talk about the levels of, approval and coming from a banking world, you would be like, this is so easy. We just need to do this one thing. But it takes 6 months to get done because it has to go through all these committee levels and things like that. So, much like your business, Delmar Mortgage being an independent mortgage banker, we're able to flex on that as well because we don't have a board. We don't have to wait on, all these levels of approval, which, again, no pun intended, allows us to pivot. If there's something
Right.
that's changing, if there's new technology and it makes sense, we're just going to adopt it. And I feel like that's a huge benefit of being an IMB in today's world, is not to be handcuffed by the boards and the levels of approval that have to take place. Are you seeing that with a lot of your clients?
Yeah, I mean, I think, one of the things that I just want to clarify on, being able to move quickly, just because you move quickly with less sign-offs doesn't mean you're not doing it in a compliant way. And you
Mm-hmm.
absolutely are. You're going through those strategies, structures, assessments. But yeah, I mean, I actually encourage our clients, to make those changes, to seek out more diversified products, to understand them and not necessarily listen to the shiny ball headline that's being talked about today, or
There's a lot of
candidly
those.
or candidly read the 900 word write up of God knows how many people on LinkedIn these days, and then decide that's how you're going to run your business. Please don't run your business that way. And I think, you're right. And I think that actually empowers the independent mortgage banker to
Mhm.
take it to the next level more quickly. A lot of people like to say, well, the banks are really lucky because their cost of capital is less. True, but they also have roadblocks at
Mhm.
times that really don't let them execute as efficiently as the
Yeah.
independent mortgage banker.
And the cost of originations keeps going up
Yeah.
and up and up. And it's a number that is almost hard to accommodate for these days because compliance and everything else that's going on. So we're seeing a lot of new technology come into the business. And it surprises me sometimes how slow we are to adapt to
Oh, the
technology.
industry in general? Yeah.
Yes, with as much as we change every day. The only thing constant about mortgage is that it's always changing. Do you think the companies that are getting on board with the tech products, the AI products early and are early adopters are going to reap the benefits of reduced loan origination costs and overall profits?
It depends. And the reason that it depends is how are they doing it,
Mhm.
right? So, it's not like you like plug in an AI chatbot and it works by itself, right?
Mhm.
And they're really, AI and everybody's using, the LLMs and everything
Mhm.
else is really only as good as how you train it,
Yeah.
right? At the end of the day, an LLM is really a statistical model, right? But you have to train it and program these engines in order to say, this is what I want to solve for. These are the 17 steps that it takes to figure out the answer, right? And then you have to look at not two times, like 2,000 times
Yes.
what their outcome
Mhm.
is to see if in fact it's doing it correctly, and then refine and refine. Now that doesn't mean it's going to take you like 35 years to do that, but the guys that roll that stuff out and all
Mhm.
of a sudden they're going to automate their underwriting with it and they don't do that check that I just talked about for each and every component and stuff like that, AI and certain other, technology will eat them alive.
Yeah.
Those who do it right, implement it, structure it, test it, etc., it will help, but it's not going to do it overnight.
Yeah. We've been really fortunate here at Delmar Mortgage is we are early adapters. We have been in many aspects of technology and, back to the if I get bored, I'm probably not having a good time. So our leadership, here I am. I'm an operations girl. I'm an underwriter at heart. I know how to turn on my computer.
Thank God.
I know how to work it like for job purposes, but I'm not a tech person, nor would I ever claim to be. But we started to dip our toe in the AI world, and it has been unbelievable to watch what just like you said, training that chatbot and bringing that technology to our sales staff has redefined what our sales staff can do independently.
Yep.
And there's just so much fear in our industry that AI is going to take over our jobs. And I remember when LP and DU rolled out, and as underwriters, we're like, "Oh my gosh, we're not going to have a job anymore. These engines are going to take our
I'm pretty
jobs."
confident you still have a job.
Yeah, 25 years later, I'm still sitting here and still doing the same job. But it's fun to watch it, and when utilized correctly, you talk about rollout, we're 6 months in and we're still testing.
Yeah.
But, is something that's going to enhance the experience for our customers. It's going to make our sales staff more efficient, more knowledgeable,
Right.
and be able to deliver a better product faster to the consumer.
But I also think, thinking about customers, each and every IMB also has to think about who is their customer base,
Hmm.
right? And depending upon who that customer base is, and I don't mean this in an ageist way, what their age is, are they younger, are they millennial, are they a boomer, are they this or that, is deploying this really going to get them that, return
Yep.
on investment, I think is also important. And there's studies out there of exactly who will engage with technology and who
Yes.
won't. And you'll find it even in rolling out your own. You'll figure out which borrower and structure and what will really
Which loan
become
officers,
positive.
adopting the,
Well, the other thing, yeah. Well, that's the other thing that
yeah,
nobody talks about, right?
right.
Any mortgage company can roll out whatever tech they want, but if nobody uses it,
Hmm.
then what are we spending all this money on? And, that's a great example of where you really have to test and really go back and say, what's my up and downstream impacts, right? The other thing is make sure you're not rolling out tech that's going to help your loan officer, but your underwriters don't have the way to get the
Yeah.
info out that allegedly is the value add. So too much siloing with tech actually can cause a detriment to a
Yeah.
business as well. So I think, again, that whole life cycle really needs to be looked at.
So talking about life cycle, I think statistics came out here recently that maybe you can touch on the average age of the first time home buyer.
Yeah.
It's not a young age these days for the first time home buyer.
37 to 40 years old.
Yeah.
Yeah.
And so sensational headlines that are also coming out right now, whether they come to fruition or not, is you have an average first time home buyer at the age of 37, and we're talking about a 50-year mortgage.
Yeah.
How does that make sense?
It doesn't. And it's funny, I actually wrote a whole big thing on LinkedIn and put up a sample on this. And I think what I used was a $350,000 loan. And, when I actually looked, it was a 50-year fixed,
Mm-hmm.
right? And everybody forgets longer duration means higher rate, right? And what's the other big, firework that we're all talking about right now? Affordability issues.
Yes.
So when you looked at those two side by side, a 50-year and a 30-year, the borrower saved a whopping $39.11 a month. But They also
how much
lost.
equity do they lose?
Off the top of my head, because I don't have it right in front of me, it took the difference would have been by year 10, you would have been down 40 something thousand. Versus you would have earned additional 45 or 42,000 in equity that was already available to be cash if you sold your house or not.
Yeah.
It was big.
And of course, loan size matters, right? When we're talking these numbers, we're talking
Absolutely.
average loan sizes and things like that. But it's an interesting dynamic because we're coming off of a decent year, you know, certainly a better year than we've had since COVID.
True.
And, you know, these new products and affordability is the buzzword at every facet of the industry right now. But we're also grappling with, you know, home prices are still rising at an uncontrollable level, which takes affordability. We talk about, you know, we had a 3.6% increase in our conforming loan limits this year. You know, that's when
not enough.
You know, when I got into this business, I don't even want to tell you what the conforming loan limit was.
It was low.
It was low,
Yeah.
you know. So now close to $900,000, you know, is that affordable and attainable?
The answer is no, right? Like, I mean, the answer is yes and no. It really depends on the MSA of the borrower, you know that, right? But there's also markets that value is declining, right? And, you know, that has to be paid attention to. I'll tell you, I saw one person saying, oh, in 2026, we're going to have a 50% value decline in resi real estate across the board. And I was like, yeah, no, right? And it was funny because if you took that person's actual forecast, right, and use their own data to look at it, like the answer was like 26. And they were like putting this headline out there that it was like 50 and it was only in like 10 markets.
Yeah.
And it's like, can we all stop with the, you know,
we can't base everything off of West Coast, East Coast demographics.
And it's like, can we get to like the reality of what the real estate market is? It is very different depending upon what state, what county, what everything. MSA, rural, non-rural, like what are we doing? And stop making broad brush comments about everything. I'm tired of the shiny ball. Like I almost feel like it's like, you know the old school Batman cartoon?
Yes.
Right? And the word bubbles would come up. Bam, pow, whatever it is that's going to, you know, send a flock my way to read whatever I'm putting out there. Let's just say it. And it's like, what happened to the integrity?
Yes.
You know, one of the things
everyone's
that I remember,
an expert behind their keyboard.
Yeah, but one of the things, you know, I remember coming up in this industry, you know, was the amount of detail that people really knew about mortgage industry and more about markets and property and, you know, really being able to have more in-depth conversations. And, you know, things have gotten too siloed, I think, in some ways. And too much on follow me. And it's like, yes, all of these tools are good tools if used and deployed properly, but also have integrity, right? Keep that integrity. You know, people may not like what comes out of my mouth sometimes, but it's always true, right? And I think that's important. Don't sensationalize just to get clicks.
We often get questions, what do you do, right? What is your job in the mortgage industry? And, you know, I think every day it's a different answer. But if I go back to, you know, who I identify as in the mortgage industry, it's an underwriter.
Yeah.
And we have an ongoing joke here at Del Mar Mortgages. Our underwriters are overpaid readers. We take the time, we research, and they are your subject matter experts. And I think it's really important to understand that not every post out there does have accurate information.
So I was on, MBA has a program called Future Leaders.
Yes.
And I was one of the guests for that. It was actually yesterday. And I said to Alicia, who runs those particular sessions, well, ask them what they want to talk about. Ask all of these people what they want to talk about, and let's talk about that. Like, let's not do something that we decide. And one of the questions that came up was just like that. You know, with everything that's going on, people aren't getting promoted more and we're not as important. And, you know, where are we going to be? And, you know, do you think there's any role in the industry right now that is extremely important and also has an opportunity to really set themselves apart? And my answer was manual underwriters.
Yes, absolutely.
Right?
It's
A
lost
manual
art.
underwriter is a real commodity these days. You know, with everything that's been going on since, you know, the housing crisis and whatnot, lenders in general have gotten a little bit too married to that AUS.
Yes.
And that's another issue. 92% of all loans should not be GSE and Govy loans, right? We need to, get that diversification, back into lending and have products and programs and to really help all
Yeah.
borrowers and home people who should be homeowners.
Yeah.
You talked about affordability earlier. Well, rates are lower than they were. But why do I have a bigger affordability crisis, right?
Hmm.
So everybody spends so much time talking about rate, but let's start talking about some of the other stuff that's really crunching us.
Heating, cooling costs,
Insurance,
insurance. Yeah.
taxes, the increases, heating and cooling costs, all of those different things. And, are we really, is it really the rate? And everybody just screams, Fed, Fed, cut the rate. And it's like, even if they cut the rates more in certain markets, you're still going to have this problem.
Yep.
So it's time to really find solutions
Mhm.
for some of these things. And insurance is like out of control for homeowners insurance in certain locales.
It's
And
crazy.
and it really needs to be dealt
Well,
with.
and it's such a scary thing to talk about because you have low to moderate income borrowers who maybe don't have a mortgage because they're in generational housing.
Yep.
And the insurance and taxes alone, they make that tough decision
Yep.
to let their homeowners insurance lapse because they can't afford it even without a mortgage
Well,
payment.
think about the fires in California and
Mhm.
Palisades and everything else. Even on multi-million-dollar homes, they let their insurance lapse. And now you're dealing with what am I going to do? Somebody owned a $3 million house and they had no insurance and it burnt. And it's like, guys, we got to be doing better here.
Yeah.
And but that's one of the things that really bothers me. Everybody spends so much time just focusing on this one thing. And mortgages are not about a single focus. Mortgages are holistic, right? What product does this borrower need to achieve their goals? How are we going to give it to them? And quite frankly, can they afford and pay it back? And, really, really having those discussions. And I'd like to see a lot more of that. I'd really like to see the industry, focus on these things. And I don't just mean the trade organizations. I mean, those of us that are really in the trenches and,
Mhm.
taking part in not only the manufacturing, but the full life cycle of, the secondary and capital markets and securitization and liquidation and asset management, really, focusing on ways to get this to a better place.
So looking forward, 2026, who knows what the year will bring. Some important things to keep in mind for those, whether you're an IMB, a banker, what are the things to really watch for in 2026 that could make or break your business?
Well, I think risk first and foremost, and counterparty risk. So, and diversification. So think about this, guys. Like nobody should ever be beholden to one person or one entity to decide if you live or die, or quite frankly, if your business lives or dies. Right? There's a lot of unknowns. Mortgage market in general has been so agency driven for such a long time
Mhm.
now, and that's not really what the GSEs were created for, right? They were created for certain liquidity outlets on certain products. But with that said, we got to get back to a place where we remember that not all lending programs were villains.
Mhm.
And one of the examples I use, because it's the one that everybody says was the most evil product ever created, the option arm, right? And it's like the product wasn't evil.
It works.
It was
It works
created.
for a certain set of
Right.
borrowers.
And it was created for a certain kind of borrower, mostly high net worth,
Mhm.
different types of things. But, when the industry allowed it to be, given to
Universal.
$30,000 wage earners, that's not a good idea, right? And that's not redlining. That's just saying, look, this was supposed to be more of a private wealth product and, you don't use it everywhere. So, I think that we have to get back to remembering, and, for the younger people in the industry, although, the age bracket of people in the mortgage industry is also very high right now, explain the why.
Mhm.
These products exist for a reason. When does an interest only loan make sense, right? What is the strategy for this homeowner? If somebody's just relocating somewhere and knows they're only going to be there 2 years, but it makes better sense to buy a home versus not, and they're going to sell it in, 2 years, it doesn't really help them to have a
Yeah.
30-year fixed. So again, I think really understanding what is your borrower looking to do with these homes? What is the longevity of the timeline they believe they're going to be in them? And what are their goals,
Mhm.
right? And then help those borrowers achieve those goals. And the lenders that really do that, they're unstoppable, right? Everybody right now is spending so much time on, oh, I got this huge MSR book, so now I can, be the
Mhm.
kingpin of all things. Well, it's the kingpin of all things that bought the big MSR book, right? And they do the most originations. But with that said, that doesn't necessarily mean that you're going to win more than, a more diversified independent mortgage banker that really understands product,
Yeah.
right? And so I pontificate, regularly. Diversification first. Costs.
And
They're off the hook.
costs are going to continue to rise. We were just having a conversation earlier today about the cost of credit and what's going to happen. And, we're already at historically high costs in general, but the cost of credit reports, it's extreme.
Right. And, one of the things I said during that conversation today was, everybody's spending a lot of time talking about FICO and Vantage, but I think a lot of people are not spending enough time talking about the three credit bureaus, right? And where do the FICO score and the Vantage score get? What data are they manufactured off of? And it's the bureaus, right?
Hmm.
Well, what has happened to pricing with the bureaus? The headline's always about FICO, keeps, increasing their pricing. Well, that's also because the bureaus keep increasing their
Yes.
pricing. And there are multiple component parts to the pricing for scores in general. But, again, where's the monopoly, right?
Yeah.
So now we got competition and, the algorithms from a scoring perspective and diversified products. Well, I don't have competition at the bureau level. And, they got lots of complaints as well that have been said that, the data's not clean and whatnot. And, since we're talking about the convo we had at lunch, I said straight out that my own tri-merge has problems with it.
Yes.
Certain components show debt that's been paid off for years. Certain components, show wrong balances.
Hmm.
And I'm worried about the fact that the industry is calling for a one score model. Even though at times lenders may like the idea. Well, what happens when, you miss 4 different loans for a borrower that you only would have seen with, the other credit bureau data? And, your underwriting guidelines required, XYZ, and they couldn't have more than 3 investment loans or something.
Right.
And you miss it. Is that going to be the next thing where even though a single score is okay, that, we start to see putbacks or repurchases based on the fact that you didn't review 3 credit reports but only needed 1 score? And you know what? That's not okay.
Yeah.
So if we're going to start to see like a mass migration into different things, then we also have to remember what the trickle-down impacts are of those things, and then adjust accordingly. If the GSEs agree with a single FICO model, which they allegedly will, great. They're saying, okay, if you miss stuff on the other 2 bureaus that you didn't
It's on
use,
you.
it's okay. Well, good. I hope the GSEs are, comfortable with that credit risk and everybody else, because it's not going to be the lender that's at fault there. They're only, going and underwriting to the requirements and the things that you say are okay to deliver loans to you. And that goes for any aggregator.
So we've had a big win this year in the elimination of trigger leads. How do you think that's going to...
Well, I'm waiting for it to be really enacted.
Right.
Yeah.
But do you feel like that's a good win for preserving your client base and preserving your prospects?
Yeah, I mean, I personally think that a lot of borrowers, if all of a sudden they're getting like 35 phone calls a day from, 19 different lenders, because some of them call you twice a day, which, by the way, they're not allowed to. I think borrowers are going to they're going to end up with a little bit more of a natural confidence for the lender they're working with.
Mhm.
What bothers me about trigger leads, and I have a mortgage, right? And
Mhm.
I remember the reaction when, my credit was pulled from my mortgage. And I think I got like 750 phone calls in like, 3 days. And, and a lot of the time, those people that are making those phone calls, and some of them are also chatbots at this point, they're telling you things that are just not real
Mhm.
to try and, move a loan to an entity. And be careful with that stuff, right? So triggered leads, I think is going to make a huge difference. That's my opinion. I think it's going to cause less borrower confusion. And I also think it's going to make, lenders work a little harder to really bring in their lead gen instead of trying to steal another lender's lead gen.
Yeah.
And that's just not cool, right?
I
Lender
think
works hard.
it's going to be hard. It's going to be hard for some companies to adapt to this.
Yeah.
But
Great.
thankfully, companies like Delmar, independent mortgage bankers, your mid-size companies that really put a focus on providing good customer service are really going to win with these changes.
I 1,000% agree, but I'm also quite certain that Del Mar wouldn't have lost the mortgage to a trigger lead person just by virtue of knowing the caliber of your team, and
We're
I
very
think that's
fortunate here.
important. Yeah, I think that's really important as well. You got to stop thinking that, I don't need loan officers in order to manufacture loans. You do, and you need good ones.
And that's an interesting dynamic, and we'll hit maybe one last topic before we
Sure.
wrap up today is, we've talked about AI, we've talked about cost savings, we've talked about affordability, but the culture of the home buyer today seems to be changing.
Yes.
And where when you and I started in this business, it was face-to-face applications. Clients would come into the office and you would handwrite your applications out, and it was a very personal level of service. And over the past 2 decades, we've gone to applying online and uploading documents, but it seems like this new set of borrowers coming into the marketplace for the first time are craving that relationship again. They want to trust their financial advisor. They want to know their financial advisor. Do you think we're going to see that come full circle where we're maybe not taking handwritten applications anymore, but where your mortgage consultant, your mortgage lender is truly your financial partner?
So I think yes and no, right? I think that there are organizations that are not going to commit to doing that. And, there's a place for them in certain ways. I do think that absolutely there are those people. I'll tell you what bothers me. There needs to be better financial literacy
Yes.
taught. And actually, I've been spending a lot of time on that lately. I actually have spoken at a couple of universities and things about just this and what our industry really is and how to deal with it and whatnot. But there needs to be better financial literacy. There are a ridiculous amount of people in this world, especially in the United States, that have no idea what their mortgage means. They have no idea what happens if they can't pay for it. And it's actually something I think about a lot, and I'm actually considering putting together something more so. You look at, personal finance or building wealth programs in high school, they're still playing the stock market game, guys. And it's like nobody's playing that game anymore. And they're even teaching kids how to balance a checkbook. You guys remember checkbooks? Nobody uses anymore. And it's like, yep, that's not really how this works anymore. So I think first and foremost, we need better financial literacy. I actually think the lender that enhances the experience for the borrower to really explain the mortgage process is going to set themselves apart big time.
I agree.
And so to your point, yes, I do think that's going to happen. I think the mortgage companies is going to become more and more important. And what's kind of sad is that the banks just really cross-sell everything. They don't necessarily explain the why.
Mm-hmm.
And
products the consumers don't need.
And right, products that consumers don't need, and fees they're taking on that they don't know about. And so again, I think especially a company like Del Mar, right? One of the best things about coming to the office is Matt gives you a tour of all the pictures of the offices over the years at Del Mar. And Del Mar has been around, if you guys don't know, 60 years.
Yes.
And that's huge, right? How many mortgage companies can really say that they've been a multidimensional family business over a 60-year trajectory, and they are here today? Talk about living through cycles.
Yes, absolutely.
Right? And I think that also is going to become important to borrowers. How long have you been in this business? Do I really believe that you know what you're doing? And am I getting that comfort?
This young generation of home buyers is doing their research.
Yeah.
They are searching us out and learning everything about us before they ever pick up the phone and talk to an
1,000%.
originator. So,
Yep.
Jen, it has been my honor to be with you today and have a conversation. And thanks for being with us today.
Thanks for having me, guys. This was a lot of fun. I always enjoy conversations with you, Kelly. So thank you.
Right.